All right, ladies and gentlemen, welcome in, welcome in. This is JT here. On behalf of the Ethfinance Community on Reddit, big thanks to the EV Mavericks for hosting yet again this beautiful happy hour for this day, September 27, 2024. Give us a thumbs, smash a bell if you haven't already. I can't believe it's episode 80. I can't believe we got Bancor here. I can't believe we got Dr. Mark Richardson in the chat. He's going to be connecting onto the Discord here, and we'll be able to hear his voice very shortly. Well, here we go. We're going to jump right into our opening credits here. The Weekly Doots live stream is all about showcasing the best of the week from the Ethfinance community on Reddit. This is a read-along reaction series, and if you want to follow along, head to dailydoots.com, designed and produced by our very own Hani Abu. And while you're at it, go ahead and subscribe to our podcast. It's now available everywhere you listen to your podcast. You can even purchase an episode of this show right after it's done at pods.media/EV Mavericks. If you got a Spotify, Libsyn, you can find us there as well. If you're watching the second window on Discord, watching my stream on Discord, make sure to mute that window. That'll avoid any echoes in your headphones. And as always, if you know someone who wants to get in on a piece of this action, send them my way. Well, with that, let's go ahead and jump right in. We got to look at our Daily Doots leaderboard for this day. I got to refresh the page. We got new numbers up here. Hani Abu hanging on the number 10 spot at 90. Ethical Trade at 94. 696 ETH at 98. Crypto Out Currency at 101. Set One Less at 103. Harog at 109. And I got to tell you what, Harog was on fire this last week. He had a triple kill a couple of days ago. Harog, I think, has made the Daily Doots almost every day this week, sometimes 3 times on the same day, always delivering bangers. Tricky Troll at 123. Benito 2030 at 142. Logri the Bard climbing up at 148. And Superfizz hanging on to that number 1 spot at 218. Fantastic. All right, we're going to refresh the page here. As always, I never read these ahead of time. This is for our episode number 80, the morning roundup. Here we go. Day Trader by H chimes in Ethereum. Frank the Tank, a price at 26.4530. M4G Lock at 0.4 on the it says 0.4 grandpas on the ratio, and uses Bing Video at 90,891 holders subscribed. We went up 8. Amazing. Great job. And now our weekly haiku brought to us by way of JS Tears. Caroline got 2. That's all. That's Caroline Ellison got 2 years in prison. This is good. Caroline got 2. The crypto market bumps into. Sam is a crook too. Oh my gosh. How does he do it? JS Tears, how do you do it? The weekly haiku, always fresh. And our ship post of the week, because we like to save the best for first. User caught my NetChup. Even Google realizes the price is never going to change. The context is when you Google ETH price, it was stuck on September 14th's price. This feature has been removed altogether while remaining for BTC. What is going on, Google? Come on, man. Get it together. All right. So it looks like we got Logri the Bard on the Zoom call. Mark is in the house on the Discord voice chat. Can we hear you okay, sir? Well, so we got Dr. Mark Richardson. We're going to get his audio up to snuff at some point. And we're going to talk a little bit about Carbon DeFi, which is a product of Bancor. We're going to talk a little bit about where Mark has been in his journey. And we're going to talk a little bit about other DEXs and things to come. Logri the Bard is going to co-host on Zoom for this edition because he invited Mark to come on after having some lengthy conversations with him on a different call, and thought he'd be a good guest to come have along for the ride. And of course, introduce Mark to the Ethfinance EV Mavericks community. There's no reason to waste too much time here. We'll go ahead and just move through our dudes. We got plenty to get through. All right, looks like Tricky Troll celebrates being on the receiving end of the Ethfinance community's incredible generosity. Correct me if I'm wrong. Did this start on last week's call or the week before, where it was coming? I don't know. It seemed like Tricky Troll's name came up because of HodlerCon.
It did. So in the previous call, literally during the call, we had a brief interlude where we said, Tricky isn't going to be able to go to HodlerCon because expenses, basically.
Okay.
And so he had that post. I brought it up on the call. Superfizz started an initiative that said, I'll chip in $1,000. We only need to raise $1,000 for the rest of the community. So he decided to chip in half. And then we raised, I gave like 0.1, a bunch of people gave 0.05 ETH, right? And we got more than the 2,000. I think we got like close to 2,500.
Oh my gosh.
Worth of ETH. So he's come to HodlerCon now. So feel free to read this.
Okay.
That's just the background.
I'll read this. It looks like Mark has rejoined, but I'll read this first dude here, and then we'll just do a voice-only chat with Mark after we get through this first one. I'm at a loss for words with your generosity, Tricky Troll writes. I'm so grateful to be a part of this wonderful community, and the Doots won't die until this subreddit dies, or I do. I'm going to give you guys a hint. He's really young, so hopefully they're both around for a long time. Unless Reddit nukes my account or something, but I'm sure I'd find a way around it, though. Anyway, through the incredibly kind funding, raising 1.2 ETH from Superfizz, Alanat 40, Harog, Alexis Kef, KEF, Shiftly, Coup d'etat, and Goomba Bucky, Austin ST, and Daver. I will absolutely be seeing you all in Phuket. As a token of my appreciation, I will be sending out a POAP soon. Please DM me if you donated from a centralized exchange or not, your POAP wallet with your preferred wallet. I also have some ideas for something special to give each of you in person. Oh man, what a sweetheart. Please let me know if any of you won't be at HodlerCon. Nothing big, but hopefully something meaningful. Think of it like a physical POAP. No promises just yet, but I've got an idea of something I may be able to do. I've already checked, and I can definitely change my flight for a minimal extra cost. I still need to figure out the logistics. For example, I can fly out of Phuket to Australia or New Zealand, or do I need to go back to Bangkok? But it seems I could change my flight and get credit for another flight at no extra charge, no extra cost. This leaves any extra cost for getting to Phuket, the HodlerCon ticket, accommodation, food, and airport parking for an extra week, all of which I have no reason to believe will go over my newly increased budget. I also just want to say it was impressive and bold of all of you to remember and have faith that tricky.eth was indeed my address. I have rarely mentioned that, and it could have gone very wrong if you had the wrong address. Ha ha. Finally, I just want to say that this community never disappoints, and all of the work being done around the Doots now with the podcast is incredibly motivating for me. I love to see the awesome things coming to fruition out of this community, and I hope this is just the beginning. Yours truly, Tricky Troll. What a beautiful, beautiful thing.
A little context for Mark, just because we have a sort of a decentralized vacation club called HodlerCon that we throw a vacation every 2 years, and a bunch of members from our community come to. Tricky wasn't going to be able to come. This raised the funds for him to come because we like him. That's all that is.
That's super cool.
Okay, Mark, you good? Did you unplug your nodes? You got your nodes unplugged. You got the bandwidth back. He's live with us on Discord.
His validator is leaking as we speak.
Okay, so Dr. Mark Richardson, I am told, co-founder of Bancor, I presume. And then, so we've got something that we're going to talk a little bit about today. Logri the Bard's going to be driving a lot of this this interview. I'm going to shut up for most of it because I want to hear what I know the two of you have had a discussion already, so we can learn a little bit about Carbon DeFi. But I did tell Logri I do want to get the softball questions because that's my expertise. So let's just start with what was your first project that you started? We don't have to worry about when you heard about Bitcoin, but what was like your first big project that you could lay claim to as being like when you put your flagpole in the crypto universe?
Yeah, I mean that was definitely Bancor. So, like, just a quick correction. I'm not one of the founders. I'm the project lead now.
Okay.
So, like, I inherited leadership from the founders in October of 2022. Before the pandemic, I was still an organic synthetic chemist. I was working for the Australian government, and I was forced to stay home for like about 24 months during the pandemic. I was living in Melbourne, in Australia at the time, which had one of the most draconian lockdown periods, I think, of any area anywhere in the world. I spent a significant amount of time in DeFi DAOs and speaking to founders and things about decentralized exchange. And I started to get to know the Bancor founders relatively well, and I started working on like different exchange algorithms that we might be able to implement. I developed a bunch of models that we actually have never implemented, but also introduced things that we ended up actually doing. One was like a de facto revenue mechanism that we called the Bancor Vortex back in December of 2020. And then after that, I ended up working for Bancor full time. So I picked up a full time contract as a researcher in January of 2021. And then shortly after that, I was the head of research, and then the product architect, and now the leader of the project. So yeah, the first thing that I can actually sort of stake a flag in and say that this was something that I contributed was this way to divert protocol revenue back into the token via a buyback and burn mechanism that was at the time called the Bancor Vortex, and actually still is today. We've actually just re-released a version of that called the Vortex 2.0. So yeah, that was my first contribution to the space. But since then, I've worked on much more sophisticated exchange algorithms. The most sophisticated of which is what we call Carbon DeFi, which is the newest product from Bancor. Carbon being an anagram of Bancor, by the way.
Oh,
so yeah, Bancor is
interesting.
I know I know. Like you might think it's lame. I don't want anyone to roll their eyes at it. It's meant to be symbolic of a change in direction for the project. But yeah, Bancor is really it's not the only project that I've worked on in DeFi. I've also advised about 24 different protocols, all DeFi related. So mostly lending protocols, but also other decentralized exchanges, and via accelerator programs like the Hypernest Accelerator. I've also sort of mentored new developers who are bringing new exchange infrastructure to blockchains all over the place, not just Ethereum.
Fantastic. So when did Carbon DeFi launch?
Carbon DeFi launched in April of 2022, I think.
Okay, so it's got a little over 2 years under its belt, or almost 2.5 years at this point. Excellent. And
correct.
then, okay, so, and then the last question I'll ask, just to make sure we give Logri plenty of time, because he's a Giga Chad with the high tech questions. So what, just, is there anything that Carbon differs from other DEXs in the way that it approaches things?
Yeah, it's phenomenally different. So it's completely decomposed in the way that the theory is presented. So for example, just a little bit on Bancor's history. So the canonical constant product market maker was an invention by E.L. Herzog, which is one of the Bancor founders back in 2016. And the concept behind an AMM is essentially that as your asking prices are taken, that your bidding prices come up to meet that asking price minus some delta. And this is good for projects that are trying to establish continuous liquidity for tokens, but doesn't really represent how individuals think about trading. So in general, if you're trading on like Coinbase or Binance or something, it's very, very rare that someone would try and scalp Ethereum for a few basis points, right? No, hardly anyone is buying Ethereum as it dips by a few basis points and then sells it again for a few basis points above. In general, people are taking much larger positions, going effectively long when when tokens are within a price range that they think it is undervalued, and then start going short when it's in a price range that they think it's overvalued. Like I hope this isn't controversial. This is just how day traders think. And the AMM paradigm really doesn't lend itself to that kind of trading. And so what we did was to separate the bidding and asking prices into separate objects in the smart contracts, but link them together. So you can still, you can trade exactly the same way that you would if you were using, for example, a grid trading bot on like OKX or Binance or whatever. But this is completely smart contract based and immutable, permissionless, and completely indifferent to which tokens you use and how you wish to denominate their prices. So it's not an AMM at all, right? So in the sense that, like how has it differed from the traditional DEX infrastructure? The overwhelming majority of the DEX infrastructure is AMM based, and Carbon DeFi is not an AMM. And then on top of that, we also have completely done away with the concept of liquidity pools. So the way that our architecture is designed has no need for something that is called a liquidity pool, meaning that this is where all users pool their liquidity together. And this has a couple of benefits. One is that it actually makes the contracts a little bit leaner because there's no need for like a factory contract that produces liquidity pools and issues pool tokens and that kind of thing. But also means that the protocol overall is a little bit more agnostic to the types of tokens that you would like to use. And on top of that, it also keeps very sharp divisions between different participants in the system. And this is at least observant of or anticipating an oncoming regulatory landscape where mixing user funds is going to be at least frowned upon, or might cause some legal issues for some. And especially when we're pursuing sort of like institutional participants, they like to know that if they are providing liquidity and creating orders and things, that it's not being mixed together with participants that they're unable to verify or don't know the identity of and that kind of thing. So things like travel rule in Switzerland and that kind of thing is at least possible to be compliant with those kinds of laws, even though the protocol as itself is pretty agnostic to it. So really, it's a complete reimagining of how the decentralized exchange infrastructure can and should behave.
Logri, you want to tee up?
Yeah, I thought you kind of preempted one of my questions, which is how we got here, right? So like we started with some of those individual positions and was executed kind of by off-chain market makers, things like Shapeshift come to mind. And then at some point we decided that for gas efficiency, we were going to put things onto a single curve, a formula, if you will, instead of a bunch of individual positions. And that left a lot of liquidity sort of at the edges that was unutilized. And so there was a period where we went through this like process of trying to figure out how to get the capital efficiency back. So we Curve and Uniswap went down the direction of liquidity compression, and Balancer went down the direction of let's take the liquidity at the edges and shove it into some alternative yield source, right? And the problem with liquidity compression is, of course, impermanent loss. And it's exactly what you said, that if the more liquidity you put into a place and then the price moves, the higher the impermanent loss that you're going to see. For anyone that's not initiated, impermanent loss is just a term that we can blame Hayden Adams for. It sounds far more innocuous than it is. It basically says you sold your asset and the price went up and you would have been better holding instead of putting it onto an exchange and selling your asset, right? And so we have a current problem where most of the LPs on Uniswap v3 would have been better off not being LPs on Uniswap v3. I believe that's a statistical truth. And we need to figure out what's going to come next in DEX designs to address that. And obviously, we've tried certain schemes. I know Tokamak v1 had an insurance scheme. I know Bancor v2 had an insurance scheme to try and socialize the losses and spread it around, but those have not persisted. So the current design space in DEXs I want to talk to you about is how to mitigate or prevent impermanent loss more, right? How to get the impermanent losses down while retaining the APR for liquidity providers and DEXs. So if I tee you up on that, let's sort of rehash the discussion we had before, Mark.
Yeah. Okay. So there's a couple of things, to recognize about like impermanent loss and like why it's of such cultural significance in DeFi, because I think almost everyone who is using a decentralized exchange as a liquidity provider is also trading at least a little bit, right? They have their entry points and exit points for things like ETH, BTC, and like even DeFi tokens like Aave, Compound, whatever. Like almost everyone is doing this, and there tends to be a kind of like it's not the middle of the bell curve, but like slightly right of the bell curve in terms of your acumen in DeFi that kind of attracts liquidity providers. There's still like a little bit of the long tail on the left side, but really, there are so many barriers to overcome that by the time you're in the position of contributing liquidity to a DEX, you're probably already participating in these other activities. The thing about the AMM design is that it is prescribing for you a very specific type of trading strategy, meaning that like it gives you a bid-ask spread to choose from. So like if you're in the Uniswap V2 days, it was always 30 basis points, and then when Uniswap V3 came around, it's like, okay, now we can choose the spread, and it goes as low as like 1 basis point, or sometimes even lower than that. But really, it's a very limited spectrum of trading strategies to choose from, and it's still always the same sort of self-financing, short gamma option. And the reason why impermanent loss affects, I think, people in such a psychological way is that they feel like it was something that was done to them by the protocol rather than, a trading mistake that they made, and would accept responsibility for. And that's it's a difference of approach. Because if I, for example, sold my Bitcoin, earlier on in this run at, let's say $40,000, and I thought that it was going to, get rejected from that level and come down lower, only to see the price of Bitcoin continue higher, I would still be disappointed. Like, I'm not happy with that result because I've lost money on it. But I feel like I did that through myself. That's a decision that I made. And the fact that Bitcoin continued on higher is no one's fault at all. Like, not even my fault, because I didn't know that. But had I not made that decision and continued to hold Bitcoin a little longer and sell it at a bit higher or something, the delta between those two sell points really is the impermanent loss, right? Impermanent loss is a really just abstract way of referring to what I call seller's remorse. That idea that you didn't quite call the top, and you're continuing to you're continuing to see the thing that you had sold appreciate in price, and you calculate your losses with that as a reference point. The difficulty with AMMs is that we give users this like made up sort of marketing language about what their incentives are to contribute liquidity to the AMM. So, for example, I recently gave a presentation at ECC where I pointed out that this idea of fees or fee accumulation in an AMM is actually just myth, right? There is no such thing as a fee on an AMM. There are no fees that you earn on every trade. You actually need to, trade first in the forwards direction and then the back direction to realize, profit. You're always going short something and going long something with every trade. And so if you don't close, those positions on time, then you're not really making any money. So I think that, like, to bring this full circle and sort of not carry on too far, into the wilderness, what I will say is that impermanent loss, it is no different from making a bad trading decision. The difficulty is that when people are providing liquidity to an AMM, they generally don't understand or have never been told what kind of trading strategy they're going to be executing while a part of that system, and instead have been sort of waved this idea of fees, when actually that's like there aren't any. So I think that it, like, in a better version of DeFi's history, it would have been made clear how you make money on an AMM, and that fees aren't really a part of that calculation, and that people decide whether or not they want to buy that financial instrument or not. And even if we had that version of events, it's still a very narrow spectrum of the way that people wish to trade. And we might have realized earlier on that actually the AMM is, it is catering to only the most narrow of appetites when it comes to trading assets versus each other. And we probably would have arrived at something like Carbon DeFi a lot sooner, something that says, okay, how do you want to trade, rather than the protocol prescribing a trading strategy through the user, that the user prescribes a trading strategy back to the protocol. And so you can still lose money that way, right? You can still have, impermanent loss, but it's impermanent loss that resulted from very specific trading instructions that you gave to the protocol, rather than being forced to prescribe to trading instructions given to you by the protocol. And I think that that's an important difference, even though like the overall result in terms of the impact that it has on your portfolio might be the same. In one of those, it's a result of trading decisions that you've made, as opposed to trading decisions that have been made on your behalf. And I think that that's a very important difference.
So to recap, there's two things that broad strokes that you're talking about. One is educational, or how information has been presented. People will show up to something like GMX, and there'll be a GLP, and it'll say USDC ETH 15% APR. They're like, well, I just put in my money now and make 15% APR. That sounds great to me. And they come back and actually they're down money. And they're like, what happened, right? And that's an educational, or how information is presented to the user. And the second thing you're talking about is expressivity. What is the set of financial commands I can give? How can I shape the financial instrument that I'm purchasing when I put the liquidity into the AMM or into the DEX to meet my risk tolerance and to feel more like it's a trading decision I'm making, and I'm more accountable for it, right? And optimize on that. I think there is still a large category of participants that want a more hands-off type of experience to get basically just yield on asset.
Right.
And we have seen attempts within AMMs to achieve that just basically by lowering what the impermanent loss would be. And we should go into a couple of those mechanisms. So I'll start off with one. Kyber had a system where when the price moved, at least for a couple blocks, they increased the trading fee. So rather than making it like a static 0.3%, it would spike in order to just if the price was going to continue to move, people would be paying more fees, and those fees would then offset the impermanent loss that was being experienced, right? That was one attempt. I know that Curve has a different model where basically they pull liquidity from the DEX, right? Like the actual sell wall height goes down when the price starts to move in response to volatility. What other mechanisms do you see that we're playing with that can reduce IL and get to that sort of passive APR experience back to users? Or do you think the only answer really is to add a lot more financial expressiveness to the DEX and let users have to make it clear that they're taking a financial trading decision and help them to make an intelligent one?
Yeah, my position is that the expressivity is the only way to achieve it. And the reason is that once something has been programmed in, so for example, referring to the dynamic fee mechanism that you refer to on Kyber, and referring to what I said before about the fact that there is actually no such thing as a fee on an AMM. So what is the thing that is dynamic there? What they really mean is dynamic slippage, right? The after a certain number of tokens have been bought in a certain period of time, that we can skew the curve in such a way that in order to continue participating with that liquidity as a taker, that the rate of slippage is going to accelerate. And this is a good idea, because if something is going through a hockey stick shaped, price discovery method, then you kind of want to conserve as much of the liquidity as you can on the way up. Whereas typical, price discovery mechanisms from the Bancor V1 formula, or inspired by the Bancor V1 formula, basically just enumerate all of those tokens across a geometric sequence. So there's it's known how many tokens you're going to lose as a result of a certain price change. what Kyber was trying to do, and even actually, before that, there were other systems that were doing it, Bancor V2 included, with the dynamic fee implementation. But even today, there are like modular AMMs such as Algebra that have also implemented something like a dynamic fee. But let me explain why like this dynamic fee is kind of like a red herring. Right. It's not that it's bad. Like, it does help to quell the impermanent loss, but only because you sell fewer tokens on the way up to whatever the price is going to stabilize at. You don't actually earn any fees at all. Like, because in order to earn a fee, you need to go, short at one price and then long at another price. So if there isn't much, market vibration on the way up to that level, then you're basically just selling tokens into the market. So yeah, that mechanism of adjusting prices, right, letting the price slip faster, what it does is it's giving a conservative view of the liquidity that you've got, so that by the time the price is stable at a future price, you've still got most of the tokens that you had, which means that the price is slipping very, very fast as you get there. But never confuse that with fee earnings. You still have to pay. Like, on the way up, it doesn't matter how big the bid ask spread is, you're still going to suffer impermanent loss. It's about just trying to minimize that component. The other ways that impermanent loss has been mitigated is basically through like token reimbursements, and there have been several models of this. So I think Bancor V2.1 was the first to have this kind of insurance model, but it wasn't the only one. So it also inspired projects such as, I think, Yak Finance implemented it shortly afterwards, and also Thorchain also had this kind of insurance vesting schedule. And the idea with this is that if you've got a model that can abstract away some of that impermanent loss and give back to the user basically the portfolio value that they were expecting, say for how that portfolio was denominated, then you've got basically a kind of insurance fund. And as long as that insurance fund is being topped up over time by protocol revenue, and this kind of cuts into the APR that you would provide back to the user, but that's fine. That the reduction that they see in their APR is akin to paying something like an insurance premium on their position on their portfolio. The problem with this model, as we discovered in rather spectacular fashion, is that it's very susceptible to bank running. Meaning that you can run this type of system for very long periods of time and see nothing but relative stability in the system. But at the moment where a very significant amount of liquidity needs to be insured all at once, or there's basically insurance payouts for a very large amount of those tokens on the same day or even in the same block, it's very, very quickly. The insurance fund basically runs out very, very quickly.
Yeah, part of that is just because the insurance is not denominated in the same thing as the asset being insured. So right, you have your Yak token insuring ETH, and then the Yak ETH price crashes. And the same problem would happen with something like Aave, for example, right? Where you have your Aave stakers that are effectively insuring the bad debt in Aave. If you got a lot of bad debt for some cataclysmic event, your S-Aave is going to be worth 20% of what you thought it would be at insurance fund time. And the second people see the cataclysmic event, literally while the vote is occurring in the DAO, whether to reimburse or how to handle it, everyone's going to dump. Everyone that isn't locked in basically is going to dump it, right? And by the time you go to act with your insurance pool, it's going to be worth not what you had anticipated.
Exactly right. And it's worth pointing out that it doesn't necessarily need to be in the case of Yak ETH, it's not necessarily that the price of Yak needs to crash. Like, nothing bad necessarily has to happen on the Yak price chart. That makes it much worse. But with respect to the in sort of a special relativity perspective, it doesn't matter which one is happening, whether the Yak price is going down or the ETH price is going up. And so, if you have another 2020 situation where the ETH price goes from sub $100 up to $4,500 relatively quickly, that can precipitate exactly the same kind of
Well,
situation.
I would
as,
enjoy
like,
that.
the
The insurance fund wouldn't enjoy that, but I sure would.
Yeah.
So the one of the responses that we've seen on that, it's about, we want to reduce the amount of tokens we sell on the way up, right? We want to reduce the losses and preserve the capital if it's going to go on a run. And the way that how we decide to do that is we need to anticipate how much it's moving, right? And so
Exactly.
this comes down to, how can you, as a DEX, anticipate the price certainty of the assets that are being listed to know how much of them to be near the strike price versus how many of them to reserve for the future hockey stick, right? The banana
Right.
zone, is what I would say. So, uh, how what are the inputs to such an oracle, a volatility oracle or price certainty oracle? What is on chain or off chain? How would such systems work going forward in order to, let's say you run an insurance fund on top of a DEX somehow, that extrinsic
Right.
to the DEX. I deposit my assets to the insurance fund, and they are going to micromanage the position on the L2 in order to minimize the loss and basically turn it into a yield-bearing asset that's insured for me. What would that external system need as an input? Would they just like take all the price data from Kraken and Coinbase and whatever? Would they look at the circulating supply? Would they look at just the last couple blocks of trading? Like, what would the inputs to such a price certainty system be?
Yeah, it's a question that doesn't have necessarily one agreed upon answer. So in no matter who you're talking to, the form that the answer takes is going to be, sure, there is a certain price, but then there's an uncertainty around it. And this could be, for example, a TWAP price. Like, rather than measuring the most recent price, we measure the average of like the last day of prices or the last week of prices or something like that. And because the time-weighted average prices tend to move a little bit more slowly, you don't end up as exposed to the intraday like volatility that might make these things exploitable, for example. But even then, you could compare like the TWAP price on a weekly basis versus an hourly basis, or a daily basis versus an hourly basis, and look at the difference between those two things to measure a sort of momentum, or a momentum change. And it's interesting that like all of the things that you would do here to measure a confidence in the price, you basically start re-engineering some of the trading indicators that people already use. Things like the moving average convergence divergence indicator and the RSI and that kind of stuff. So these things, like, they do indicate market confidence in some way, or like how
Turns out TradFi knew what they were doing all along. Who knew?
Exactly. Yeah, and like it's an interesting point, right? Like, financial analysts have been doing exactly that. I've been trying to answer this exact question for like,
Right,
the last 70
for the last
years.
7 years. So if they could have a better prediction on the price, and they would make more money in the stock market, more capital would flood to them. So they've had 70 years and a lot of money at stake to try and learn some of these things. Yeah.
Precisely.
The last thing I want to talk to you about
Yeah.
is a new evil that we see that's actually increasing the amount of permanent loss, and that is liquidity fragmentation. So when we get a trade, it doesn't matter where it is, right? It creates an imbalance. Let's say we had a perfectly level ETH price of 2,000. You get a trade somewhere, it doesn't matter where it is. Now the ETH price there is 2050. Now a bunch of arbitrage comes in and creates a bunch of basically value extracting transactions across the entire ecosystem, try and re-level the price, right? But whoever is on those other exchanges with the arbitrage bots are making money, right? And the money that they're making is extracting extra value from the ecosystem, basically from the LPs, right? And so,
well, that's an interesting assertion, because like I maintain that the arbitrage bots are extracting value from the takers, like not from the makers.
well,
And
whoever just bought in one exchange and had more slippage than they would have had in a unified pool, right? So ultimately, the loss is over there. And whoever was the LP on there, therefore, like the price moved more than it otherwise would have, right?
Sure, but then the back run from the arbitrage completes their short position, so the LP actually benefits from arbitrage. and there's no like agreement on this, because I think it's about how people approach this with their own like bias and perspective. But usually the example that I give people is that, let's say I've got a used car that I want to sell, and so I say, look, this car is worth $2,000. I'm happy to accept a price of $2,000. And then my friend says, okay, yeah, I'll buy that car from you for $2,000. And then he immediately turns around and sells it to his friend for $2,500. And so we agree that my friend in the middle made $500 out of this transaction. But the question is, who lost that money? You could argue that I should have charged $2,500 because, there was this other customer out there that was willing to pay that. But then the person on the other end of that exchange, the person that paid $2,500, you could make the argument that he overpaid, that he should have paid $2,000 if he had contacted me directly. So this friend in the middle, it's sure, like, he profited $500 from the transaction, but the question is completely ambiguous as to who he profited from.
That is an interesting perspective. I hadn't heard that one before.
Yeah,
thank you.
And like I said, with arbitrage on an AMM, if like let's say someone does do this trade from where ETH is at 2,000, and then they perform a trade and it goes up to, let's say it's not a fat fingered transaction, like goes up to 2010. In order for them to realize a profit on that trade, they do need to trade backwards again, right? They need to cross their bid ask.
Buy on one and then sell on the other, right? Yeah. And
the arbitrage bot fulfills that duty, right? It actually forces that trade backwards, and then pushes, the trade back through someone else's, liquidity position. So if you were the liquidity pool that actually received that first trade, arbitrage is your best friend because it keeps you relatively profitable. If you are the stoff, like if you are the another LP that is being balanced or like being brought back into equilibrium with the pool that received the trade in the first place, then it gets a little bit more ambiguous. But in general, across the board, these arbitrage bots and arbitrageurs, whoever they are, generally do a good job of keeping that wiggle happening on AMMs. And without that, if everyone was just trading impulsively, there would actually be very little returns on AMMs at all. So like, I think that it's been made into a boogeyman that it really isn't. It's a way of, I think, distracting people from the fact that you have to understand the financial, instrument that underpins an AMM. And if you lose money, I think it's convenient to build a straw man out of arbitrage and say, oh, this is why you're losing money. If it wasn't for that, you would be fine. But that's not how it works at all, because even without arbitrage, it's very easy to demonstrate that the same, the same price chart would have impacted your portfolio balance exactly the same way, right? Even if there's no arbitrage anywhere, your IL, your impermanent loss, is the same. And that's an interesting, in many cases, it's worse because you don't get that wiggle I was talking about. But yeah, arbitrage is not the villain, and it really shouldn't be. I think that it's it's a way to distract
the people selling the arbitrage narrative the most are Solana, because they want to make a boogeyman out of all the liquidity fragmentation across all the L2s and say, look, we have the 1L1, so we have less liquidity fragmentation, and all the DEX hates the liquidity fragmentation and blah blah blah. The other boogeyman that I think is a little bit more obviously extractive is sandwich attacks MEVs, right?
This one's much easier to address because, sandwich. I've got two blogs that on my Medium about sandwich attacks that are like fairly in depth and fairly technical. The short version is, in a sandwich attack, the liquidity provider, like the pool that helps to facilitate the sandwich attack, actually does pretty well. It's really the taker, the someone who's showing up at like a DeFi front end and trying to process a trade that gets like screwed. And unlike arbitrage, I think a sandwich attack is like deliberately malicious in nature. It's not something that you can ever argue is like benefiting anyone anywhere. It's like it's akin to a direct theft from someone who's trying to take someone else's market and ends up getting a price that they didn't agree to. So in terms of MEV, I do consider sandwich attacks to be among the most malicious, the most damaging.
Last thing, I guess, is a more open question, because we are going to be running out of time here pretty soon for this. But what do you see coming in the next bull market, like the next 4-year development cycle for DEX design? Are there any quantum leap breakthroughs that we're going to see, or is it going to be incremental capital efficiency gains, or just generally the march towards programmable money?
Well, I don't think that it's necessarily going to be like capital efficiency gains necessarily. I helped write a blog recently that was published by Jennifer Albert in to both the Bancor Medium, and it's on the blog website on carbondefi.xyz. And this was basically showing that capital efficiency is done. You can using the capital efficiency calculation that was popularized by Uniswap, it's relatively easy to demonstrate that you can create infinite capital efficiency even using the Carbon DeFi protocol as it exists today. But there are other protocols that you can use, even something like an intense-based limit order system, which you could argue Carbon DeFi is that. Will offer infinite capital efficiency in the way that it's currently defined. But that doesn't mean that it's like more productive, right? I think people conflate capital efficiency with like capital productiveness or like returns, and they're completely different ideas. And so in that respect, I do think that we will see not just incremental changes, but like pretty significant leaps forward. Where like even at Bancor we're working on like new features that we haven't seen anywhere in DeFi, but also we haven't seen anywhere in CeFi. And I'm hoping that these things will become available towards the end of the year, but maybe moving into next year. The point is that like we're not like DeFi isn't done, not by a long shot. I've met some of the most creative people in the world. As I've been jetting around Europe this year, I'm speaking at various conferences and so on. And there are a lot of really good ideas. And I think that the more that we continue speaking to each other and sharing, what it is that we're working on, the less stifled we're going to feel by what has been sort of the prevailing DEX infrastructure. So yeah, I don't think it'll be incremental. I think we will see, quantum leaps forward, and I don't think it's anything that I've heard anyone speculating about. It'll be surprises, which I think is a lot more exciting than just delivering on what people think is coming, like callback functions and so on.
Well, I'd love to hear that. I look forward to being surprised. I'll be along for the journey. Do you have any final closing statement? Anything you want to get out to the audience?
Just that. Yeah, if you are using DeFi protocols, if you are a liquidity provider, if you are using these different instruments, just know that there is there is good information out there. And if I've said something that surprised you, something like fees are made up on AMMs, and like maybe that caused you pause, and you would like to know more about that, please feel free to reach out to me. Like these things are very learnable. Like I have I think a way of presenting this kind of information that is very easily digestible. You don't need to be a DeFi expert or a programmer or a mathematician or anything to understand it. And so, yeah, I just want everyone to know that I'm generally very available. And if you want to speak about anything that I've said, even if you disagree with it, maybe you think that arbitrage is like a horrifically extractive phenomenon and you want to debate me on it, I'm very happy to listen. I am a trained scientist. I can spin on a penny. If I have to, I'll change my mind when presented with the right evidence. So if you would like to contact me, please feel free to reach out to our host, and I'd be delighted to speak to you about it.
Ladies and gentlemen, it's Dr. Mark Richardson, Bancor, and Carbon DeFi, amongst other things going on in his world. Thanks so much for hanging out, but you know what? You don't have to leave, because now we're getting ready to go into the Doots. If you have time and you want to hang out, just a quick overview.
I will hang out.
You will. This is great.
We would love your colored commentary.
We would love you.
Just think along.
Yeah, hang out. So what we do on Ethfinance, if you don't know what the Doots are, basically what we do is we take the top 10 or so comments, if there's of the day, and then we take all of those throughout the week and come up with a top 10 or so of the week. And we have community members that help subjectively pick those out. And then I award each one of them a point. So the rich list you saw at the beginning of the show, that's the number of times those people have appeared on the Daily Doots. And then this is our weekly toast to everyone else. So we're going to jump right into the rest of this. Of course, we saw the community rally around Turkey Troll. He's on his way to Phuket for HodlerCon. Now we're going to go down the list. I don't read these ahead of time. It's always a surprise to me too. User Buy ETH or Die reviews the Ethereum film. User Buy ETH or Die is a duder number 13. He says, or they say, just watch the documentary about Ethereum and Vitalik. I thought it was pretty good overall. There's a great scene with the recording of Charles crying about how he won't become a CEO because Ethereum is going to be a public good. I'm paraphrasing, of course. It gave me a good chuckle. The movie is here at ethereumfilm.xyz. Costs $20 in ETH for a streaming ticket. But this is stuff I like to see on chain. So props. And personally, I bought a ticket. I have not watched it yet. I'm waiting for the right time when my family is out of the house. Because they will roll their eyes if they see me watching anything related to Ethereum. They just don't get it, do they? User Harog, the hammer, has covered some big Petra changes. Harog is a freaking animal this last week. He's a duder 109. He climbed up at least 6 or 7 points just last week. And all the core devs consensus call, in the all core devs consensus call last Thursday, they discussed the size of the upcoming Petra fork. They pretty much decided to make the Petra fork much smaller again and split it into 2 hard forks. In essence, all the EIPs that are currently being live on DevNets, which are internal test nets, will be bundled into the first upgrade, whereas anything not part of the DevNets will get its own hard fork later on. The reasoning is that the EIPs that are currently tested will soon be ready for public testnets and then mainnet. Waiting for the other EIPs to be ready would delay these upgrades by several months. More details about the reasoning can be found here, and there's a hackmd.io link. Oh boy, I'm sure crypto Twitter is going to be coming out with the FUD on that news. As it currently stands, it is planned to have the following EIPs in Petra 1. EIP 2537, which is precompiled for BLS 12381 curve operations. EIP 2935, which is save historical block hashes in state. EIP 6110, supply validator deposits on chain. EIP 7002, execution layer triggerable exits. And then EIP 7251, increase the max effective balance. EIP 7549, move committee index outside attestation. EIP 7685, general purpose execution layer requests. EIP 7702, set the EOA account code for one transaction. Most important for stakers are the max EB, which is EIP 7251, and EL triggerable exits, which is EIP 7002 changes. These two allow a single validator to have up to 2,048 ETH in balance, and the advantage that one can trigger a validator exit by signing a message from the withdrawal address. The account abstraction EIP 7702 is interesting as it allows an EOA account to behave like a smart contract account. There is also the discussion to include a smaller change which would increase the blob target and max from the current 3 of 6 to either 4 of 6 or higher numbers, but there's no consensus about this yet. Notably absent from this list are the bigger EIPs, such as Pure DAS and EOF. This means we are pretty much at the size of Petra as it was initially planned until May 2024, right up before the size blew up massively by including Pure DAS and EOF. The plan is to have the first upgrade at the beginning of next year, Q1, Q2, whereas the second upgrade with Pure DAS and EOF would be at the end of next year. So, that's like a quarter of a Lubin to half a Lubin. Obviously, this is still in discussion, so details might change. No idea what this means for the already scoped Verkle tree upgrade, which is a large execution layer change, which was planned to come afterwards. I guess the next few weeks will give more clarity. And there you have Harog. If anybody has any comments on that, feel free to unmute and jump in. User Benito 2030 starts a discussion about decentralized sequencers for layer 2s. Benito 2030 is a big dog at 142 on the list. The Bankless episode with Mike Neuter was pretty interesting. I am not yet done, but one thing caught my attention. I think we discussed centralized sequencers here probably years ago and pointed out that these aren't perfect, but that we expect some L2s to have only one sequencer that will do all the work, and that there will be some decentralized L2s. My mental model from these discussions was, quote, there will be a little bit of everything. Mike yesterday basically said that he expects, air quote, all or most L2s to have a decentralized sequencer and that it is the best strategy for them because they won't be more decentralized than layer 1, inherit all the necessary properties from L1, and shouldn't even try to emphasize that dimension. His conclusion is more or less that real-time censorship resistance is cool, which is a result of decentralized sequencing, but it's probably not as important with the possibility of forced inclusion via L1. Is a decentralized sequencer only important in our bubble? The more I think about it, the more I believe it is. And we are a niche. So developing for us and similar users might be good enough for 1 or 2 L2s, but that's it. So we will see. Will we see 99.9% of the sequencers running on one machine? Question mark. Benito 23 asks you. User PA7X1 makes an observation about the supply and demand of block space. PA7X1 is a Deuter 68. It's going to keep happening. This comes from Grow the Pie on Warpcast. Let's open it up real quick. It shows a chart here. Layer 2 utility is on the rise. Account abstraction. Yesterday, over 1/4 of all layer 2 gas fees were spent on utility. Whoa. It's going to keep happening. Excess supply of block space will eventually be gobbled up, even if it's to do the same stuff, but leaner, easier, and more user-friendly. Even without the new use cases that are brought forward with cheaper block space, which I think there's a lot of pent-up block space and demand in the form of better UX and easier to write code. We saw something similar with our computers and the internet. As the resources available were scaled up, the computers didn't get much faster to do the same things we were doing. And web pages didn't load up faster. Instead, a lot of those extra new resources went into nicer UX and cheaper and easier to deliver code. We are in that era of smart contract programmers thinking long and hard about how they implement the functionality to minimize gas costs, looking at opcodes and trying to find micro optimizations to squeeze those extra gas savings. There was a time when programmers thought long and hard about the performance of their applications and would often go to assembly to optimize them. For most use cases, programmers don't do that anymore because CPU cycles have become so cheap that it's silly to optimize for that. The same will happen with block space. As it becomes cheaper and cheaper, we will start to use it less efficiently in exchange for improved UX or easier code. That is from user PA7X1. User Fimar How covers a bit of a brick wall for hobbyist developers. Fimar How is a Deuter number 72. Man, bangers this week. As a casual hobbyist developer, I keep hitting a wall at the Block Explorer verification step. You can write just about any smart contract idea you have by messing around in Remix IDE. You can deploy it to blockchain. It will run on its own forever on a permissionless network for everyone to interact with. Third parties can even build more stuff on top of your contracts. Amazing. But the moment you want to make your code easy to check on a centralized Block Explorer, there's this huge skill bump where you need to use the command line install git node.js, npm truffle, hard hat, scoop foundry, and a million other things, and none of it works anyway. Well, I say you, it is of course me, dumb old me who never gets this stuff. But still, isn't this wild? Intuitively, it feels like the hard part would be, building the actual thing rather than proving the thing you built is what you say it is. Imports used to be my main grievance. Now I'm discovering the fresh hell that is via IR verification. At least now I have AI to help me fail faster. Here's the edit. I finally found a way. Nothing like a good rant in public to have a breakthrough. Welcome to Ethfinance. You will be rewarded if you just rant on the daily. Here we go. For any other tortured soul who might end up in the same situation, the working path was this. Number 1, generate contract metadata ticked on the Remix IDE. Number 2, get the giganormous hexadecimal JSON and artifacts build info filter. Number 3, crop its contents to keep just the air quotes language settings and sources bits. Number 4, on the Block Explorer verification page, use Solidity standard JSON input in the compiler type dropdown panel. And number 5, it just works. The world is saved. Praise Vitalik. Praise all of you. I love you all. Good night.
This is programming every day, right?
Isn't that amazing? God.
You go from like feeling like a dog on a keyboard, like I have no idea what I'm doing, to feeling like a goddamn wizard, right? And you just alternate those highs and lows pretty much all day, every day.
Oh
Welcome to programming.
Gosh, dang, isn't that's hilarious? Like, you know, as a lay person, I'm reading it and I can feel his frustration. It's kind of like, I just want to put like, you know, you're doing all this work, making all these whizzy gadgets in a let's say an Excel spreadsheet, and all you want it to be on the other side is a website that just has a black square on it, and it's like it doesn't work. It's just like you're trying to get to the simple. Like it's when he said here, at least now I have AI to help me fail faster. But yeah. That's a cool.
AI does help. I'm not gonna lie, it helps.
That's the cool thing about Ethfinance. If you got any questions, drop them in the daily. There's somebody in the woodwork that just can't wait to help you.
Fastest way to get the right answer is to post the wrong one. Someone will jump in.
Let's just go to let's just look at the comment thread. So here's the original. Okay, let's see who responded. I'm going to go to the permalink. Here we go. If we go to the permalink, it should give us more. Okay, it's Superfizz replies, sounds like you've already using Chat GPT, been so valuable for helping me. And then he says, I'm in love with Claude Sonnet 3.5, feels like magic. Alas, even magic cannot defeat the dark curse of the Block Explorer. Okay, so he had a good rant in public, so maybe somebody dropped into his DMs and we don't see the public conversation of how he got there, but he's definitely given credit.
I've liked using Perplexity. I like the citations that it provides. Allows me to like basically use it instead of Google. I end up at the same websites, but end up with more reduced content before I have to go clicking around, and creates less like work on your eyes to find the relevant tidbits of stuff.
Yeah.
But yeah, AI is definitely an accelerant.
Yeah, I that's good that he found it, and it looks like it was basically 4 steps to get there. So good on you. All right, let's see. Nick Badlands. I'm trying to remember this name. Nick Badlands is a duder number 3, a relative newcomer to the weekly and the daily. All right, at least posting wise. It's different this time, the air quote. The Badlands, Nick Badlands rambles about where we are this cycle. Just sharing some ramblings to help me solidify my theory on where we go from here. I was a bit worried for a while when the hype of the Bitcoin ETFs was going on. It all got a bit too excited, too quick for me for a while. I was slightly concerned the 4-year cycle wasn't going to happen as usual. We seem to be back on course. Bitcoin still rules the jungle for now. So what is happening with it still matters deeply for Ethereum. Rate cuts have started in the US. The rest of the world is largely yet to follow course, but they will as the cycle turns. Gold is rising and Peter Schiff is getting all excited about it. But what usually follows after this is Bitcoin making him eat his words. Pretty sure this will happen again. In my gut, I think there is one more big drop still to come. There is usually some event that scares people witless before we go Valhalla. Go to Valhalla. Would love to be wrong on this, and we go straight there from this, but it fits the usual pattern. From there, we start marching on with Bitcoin leading the charge. Next, what happens is money starts to look elsewhere, and the fabled altcoin season has its time to shine. I think Ethereum will start attracting attention sooner rather than later, and considering the hate it seems to be getting lately, it will be glorious. Hated rally. by those who miss out. I'm sure others will pump, but I'm not worried by the likes of Solana, etc. It's still centralized shitcoin that's good for meme coins, but anything else? Pretty sure it will go the way of EOS, Cardano, and all the other so-called ETH killers in the long term. I've been staying well away from buying any crypto other than BTC and ETH since the 2017 cycle, and sure, I've missed out on shit, but I'm in it for the long haul. We have ETH ETFs, and we moved to proof of stake, so all those ESG green funds can take part that can't in Bitcoin. We have scaled this time. L2s are growing and growing. Crypto is getting easier and easier to use. Still waiting to see what the next narrative will be. We had ICOs, DeFi, NFTs all started on Ethereum to kick things off before. What will be next? Is it time for the long talked about real world assets to enter the party this time? Ignore all the noise. I'm pretty sure that we'll see a great bull market starting as per the usual 4-year cycle. I might even sell some of my precious ETH for the first time this time around. And that is Nick Badlands, Duder number 3 for this week. Wow, user Harrog gets on the weekly. A double kill by user Harrog. He brings a write-up expanding on the disconnect of knowledge on a recent podcast. I have finished the recent Bankless episode with Max Resnick called Is the Ethereum Roadmap Off Track? And there's a link to the YouTubes. I knew it'd be difficult to listen to for me, and I ranted about the guest a bit here before. It is mostly due to the guest being unable to contribute in any meaningful way to the discussion and making false statements everywhere. Now that I have finished it, my conclusion is this. Should we really listen to someone on their opinions about rollups who seems to have such a gross misunderstanding how this stuff works? He might have very good opinions about the MEV part of the roadmap or about auctions. I cannot judge that, but he seems unable to understand how the roll-up part really works. I keep it to the largest issues I have heard and leave out many smaller wrong statements the guest made. To be very clear, my understanding of rollups has a lot of gaps, so please correct me if I'm stating something wrong. I am eager to learn. And then it goes into a long question and answers series with himself and explaining away. I'm not going to read all of this. You can find this at dailydoots.com. I am going to go to the last paragraph here. The rant is finished. I now definitely have a worse opinion about him. And that's something when you actually muse and prose on a topic, you actually develop stronger feelings than when you started. When you start looking at, I mean, he's got, let's look. I'll scroll up here real quick because it looks like, how many points does he go? After the 55-minute mark, he's got a point here, point number 2, point number 3, point number 4, 5, 6. Yeah, okay. So his last paragraph, the rant is finished. I now definitely have a worse opinion about him because he does hold strong opinions about things which he apparently does not really understand. This makes it very hard to judge if his opinions are worth considering, as one cannot really say from his statements where the limit of his knowledge is. Everything has the same strong absolute language. There is no nuance, nothing. And only if one perfectly understands the underlying technology, one can judge if his statement makes sense. Well, that's not very helpful for most people at all. Man, if you're going to be in a debate about Ethereum and what underlying technology stuff is, Harrog is a champion. Like, he would be
one of my blog posts. I have a quote. Forget where it's from. It says, "The problem with the world is that all of the ignorant people are full of confidence and the intelligent people are full of doubt." And that's exactly what we're seeing here, right? The man's confidence is completely unrelated to his competence in each issue.
Do not confuse conviction with expertise. That is the quote I heard. It was the Modern Wisdom podcast with Weinstein. What's his name? Eric Weinstein. I can't remember his first name. He's a high brain mathematician, physicist from Harvard. But that was a quote actually that the podcast host from Modern Wisdom, he said, I need to find the timestamp. It was so good. Do not confuse conviction and the belief in what you're talking about to be passed off as expertise. So I think that's what Harrog is kind of upset with. This guy, there's obvious holes in his judgment, and you feel like he could be completely wrong on one side. How much stuff does he have full conviction on that he just really doesn't have the expertise in? You know, I love that juxtaposition of ideas. I mean, I was fully convinced that Funfair and OMG were going to do something, and out of both of those, Funfair actually shipped a product, but the expertise didn't understand like online gambling with, you know, cartoonish slot machines probably was not going to be popular, you know, stuff like that. But I was convinced, you know, I mean, I invested, I lost too. So whatever. All right. Super Fizz says goodbye to Danny Ryan for now. Oh my gosh. We're not supposed to be cutting onions in here. Yesterday, I announced the Goodbye Danny POAP. It's a POAP to appreciate the contributions of Danny Ryan, the person who's most responsible for the Ethereum beacon chain as we know it. It's launching with a new POAP platform called Airship. Airship lets you send funds to an address to receive a POAP without the need to connect to any Web3 browser wallet. Interesting. Effectively, if you send 1,000th of an ether, exactly $5 at today's prices, to the protocol guild.eth on mainnet, you will receive the POAP in about a minute. Well, that's kind of a cool evolution, and Superfizz is excited to see where it will go. Also, I definitely encourage gaming this to get the POAP with the minimal gas cost. How long can you go? The worst that could happen is a drop transaction, and you can just try again later. All right, so airship.poap.xyz/Danny. Here it is right here. So you're going to be sending to this address here. I guess you just copy this address, send a 0.001 ETH or whatever you want. Oh, look at Whoa.eth. This is one of our friends in the there's Tricky Troll. Haha. I love it. I need to get mine. There's Whack Whack. I love seeing all these familiar names in here. That's so fun. Good. Okay, so Protocol Guild, there you go. All right, very, very cool. Let's see. It says POAPs minted 100. We could do better than that. Everybody get your POAP. Goodbye for now, Danny. Gone, but not gone. He's around. He'll be back. I know it. I can feel it in my jimmies. All right, enough of that. Logri the Bard rounding out this week. Here we go, Logri. Logri is number 2 on our leaderboard on dailydoots.com. Some thoughts on EigenLayer's operator set security model. AVSs assign operators to operating sets. Okay. I don't know if this means that by default all AVSs are whitelist only, but it certainly reads that way. It's not the epitome of permissionless if true. Stakers delegate stake to operators. How do stakers find an operator to delegate to? At the moment, there's a list on the EigenLayer website, which basically means EigenLayer can exclude an operator from participating just by censoring them here. I'm hearing the words in my brain. Trust me, bro. At the protocol level, though, I don't believe they have any power, so it's just like Uniswap with their front end, which I guess is good enough. The bigger problem, though, is why does a staker trust an operator to delegate to them? At the moment, the only answer here is trust. You're either trusting someone you know, like Astus, or you're trusting an LRT to underwrite for you, KYC your operators, etc. We need a better answer here. Operators then assign unique stake to operator sets. The goal here seems to be to prevent restaked ETH from being restaked multiple times, which is confusing to me. It's already the case that the underlying stake securing a task can become unbacked. Why is it suddenly different if it becomes unbacked within EigenLayer rather than at the LST level? The proper answer here is that capital should be reusable to the extent that the cost of dishonesty still outweighs the profit from dishonesty. The cost of dishonesty is the stake being slashed. The profit from dishonesty scales with the amount of promises you're allowed to make with that stake. I don't see how this security model is even attempting to discover a rational answer to that equation. Within an operator set, operators are expected to vote on whether the answers of the other operators are correct. Their vote is weighted by the stake they assign to that operator set. The thing that feels wrong about this design is we are using restaked ETH as a Sybil resistance source when the nature of being an operator on an AVS consists of doing provable work. Why not just use the proof of work as the Sybil resistance source for this? I have the same feedback for subnets on BitTensor. Why do we need validators for that at all when the miners have the hardware to validate and the miners have to do work so the system can't be Sybiled? They state that if a malicious operator takes over the operator set, the system can slash him. I assume this refers to the eigen governance system above the AVS, but they aren't explicit about this. All they say is that the only stake at risk within an operator set is the stake assigned to the operator set. I refer to stake voting schemes as subjective consensus. Ultimately, even with the objective proof systems, it still comes down to who runs what software. For example, Ethereum Layer 0. But why involve local operators set at all at that point, since the eigengovernance system participants will apparently be required to host all the proof validators for all the AVSs, since operators in every AVS will be allowed to appeal to them. If the goal is to reduce the computational load on the eigengovernance system participants, then I'd say you should first vote using proof of work within an operator set and then appeal to a contest amongst all the operator sets on the matter. And every appeal should require a slashable stake to initiate. That looks a lot more like the colony governance design than what I just read. It's also worth noting that an operator only needs to be slashed in an eventually consistent way, so ZK proofs that rely on repeated games are perfectly valid here. There's a long unlock period for validators to unstake from AVSs. I also don't know what happens in this model if a staker undelegates to an operator. Which operator sets the unique stake removed from? Is it proportionate, LIFO, etc.? And how does stake affect rewards? Can an operator just forfeit their operator set consensus power but do honest work without any stake and still be rewarded? There's just a lot of undefined aspects to this system at the moment. And that rounds out your week, Logri the Bard, number 2 on the Doots Rich List. Well, that concludes our show for today. Thank you, Dr. Mark from Bancor, for hanging out with us and chatting with us today and taking a little bit of time out of your busy schedule and hanging out all the way to the end of the Weekly Doots call. Thank you so much for being here.
Thank you so much for having me. It's been an absolute pleasure.
Yeah, come hang out anytime if you want to hear me read Reddit, so you don't have to. Well,
I'm gonna come back. These are terrific posts.
Yeah, that daily thread, you know, there's some days we don't even have like 300 comments in there, but we got so many freaking brilliant people. And
really, the dudes do a decent job of filtering. I know there's some like editorial jurisdiction here, right?
Yeah,
but
subjective.
It definitely eliminates all the random price whining, right? At least if you're getting someone whining about the price, they're going to have some decent justification for it. You know, it's quality content. It's definitely higher signal to noise than just like CT on your average day. So, I think it's worth popping by, at least for the weekly Doots, sometimes for the daily Doots. Just it's the best of content.
You're welcome. We'll get you back on the calendar 6 months or a year from now. If you want to join us again, we'd love to have you. And if you know of anybody out there in your contacts list that wants to hang out with us and tell us what they're up to, we're always looking for guests to join us at 2 p.m. Eastern. And yeah, it's great. Thank you again. All right, so stick around after the live stream because we continue the party in the hotel lobby on Discord for a bonus hour of popcorn. It's a fun place to let loose when the parents aren't watching on YouTube. Hi, Mom. On behalf of Ethfinance and the EV Mavericks DAO, my name is JT. Cheers and big hugs from Kansas City.